Income tax is a tax imposed by the government on individuals, businesses, and other entities based on their income or profits. It is one of the primary sources of revenue for governments and is used to fund public services and infrastructure. Here's how to understand income tax and calculate taxable income and deductions. Understanding income tax. Income tax is typically levied on various types of income, including wages, salaries, interest, dividends, rental income, capital gains, and business profits. Tax rates and brackets vary depending on factors such as filing status, single, married filing jointly, married filing separately, or head of household, taxable income level, and applicable tax laws. Components of taxable income. Taxable income is the amount of income subject to income tax after accounting for certain deductions, exemptions, and adjustments. It is calculated by subtracting allowable deductions and exemptions from total gross income. Calculating gross income. Start by calculating gross income, which includes all sources of income before deductions or adjustments. Gross income may include wages, salaries, tips, bonuses, interest income, dividends, rental income, capital gains, alimony received, and other sources of income. Identifying adjustments to income. Determine whether you qualify for any adjustments to income, also known as above-the-line deductions, which reduce your adjusted gross income, AGI. Common adjustments include contributions to retirement accounts, e.g., traditional IRAs, SEP IRAs, or simple IRAs, student loan interest, tuition and fees deduction, self-employment tax deduction, and health savings account, HSA, contributions. Calculating adjusted gross income, AGI. Subtract the total amount of allowable adjustments to income from gross income to arrive at your adjusted gross income, AGI. AGI serves as the starting point for calculating taxable income and determines eligibility for certain tax benefits and deductions. Claiming standard deduction or itemized deductions. Determine whether to claim the standard deduction or itemized deductions, depending on which option results in a lower taxable income. The standard deduction is a fixed amount that varies depending on filing status and is adjusted annually for inflation. Itemized deductions include expenses such as mortgage interest, state and local taxes, medical expenses, charitable contributions, and certain miscellaneous expenses. Calculating taxable income. Subtract either the standard deduction or total itemized deductions from AGI to calculate taxable income. Taxable income is the amount of income subject to taxation at the applicable tax rates. Applying tax rates and brackets. Determine the applicable tax rates and brackets based on taxable income and filing status using the current tax tables or tax brackets provided by the IRS. Tax rates are progressive, meaning that higher levels of income are taxed at higher rates. Calculating income tax liability. Multiply taxable income by the corresponding tax rates to calculate the federal income tax liability. Consider additional factors such as tax credits, estimated tax payments, withholding, and other taxes to determine the final tax liability or refund amount. Reviewing and filing tax returns. Review the calculated income tax liability, deductions, and credits for accuracy and completeness. File your tax return by the due date, usually April 15th for most individuals, and pay any taxes owed or claim any refunds due. By understanding the components of income tax, calculating taxable income accurately, and leveraging available deductions and adjustments, individuals can minimize their tax liabilities and comply with tax laws effectively. It's recommended to consult with a tax professional or use tax preparation software for complex tax situations or if you're unsure about your tax obligations.